Grave, observational tone. Pushing the engines to full throttle when you are heading into a hurricane does not guarantee you will cross the ocean faster. It usually guarantees you will tear the hull apart. Yet in most boardrooms, executives default to slamming the accelerator. Pressure from investors and leadership ego create an environment where continuous aggressive expansion is viewed as the only acceptable direction. This behavior is driven by a deeply ingrained assumption that pausing operational output is a failure of ambition and that reducing the size of the company is an absolute defeat. A diagnostic leader ignores this pressure. Instead of acting on ambition, they analyze the objective reality of the market and their own internal operations to dictate their next move. Consider what happens when these two approaches clash. A board might demand a 20% annual increase in sales, ignoring the data that shows their total addressable market is actually shrinking. To hit those mandated numbers in a contracting space, the sales team has no choice but to slash prices, triggering a severe margin war with competitors. The company bleeds out its critical cash reserves to subsidize the discounts, taking on heavy debt and crippling their own balance sheet to maintain the illusion of progress. To avoid this, a diagnostic leader relies on a clear evaluation of three distinct objective paths: growth, stability, and retrenchment. Dictating a target based on executive pride, rather than matching your strategy to your operational reality, is a predictable trap. It destroys the very foundation that allows a company to operate. The first option is the growth strategy. This is the corporate accelerator, designed explicitly to increase total asset size and aggressively capture market share. You can execute this through vertical expansion. A wholesale beverage distributor might launch their own direct-to-consumer retail stores, moving down the supply chain to capture the final retail margin. Alternatively, horizontal expansion skips the build phase entirely. A company uses its capital to acquire direct competitors, instantly absorbing their customer base and market share. This directional matrix illustrates the specific mathematical conditions required to justify each path, starting with growth. You only press the accelerator when the data proves your target market is actively expanding, and your balance sheet holds excess, uncommitted cash reserves. Without those prerequisites, you expose the company to the primary danger of rapid expansion, a critical failure point known as overtrading. Overtrading occurs when you sell so much so fast that you outpace your working capital. The orders pile up, but your back-end systems and cash flow break down before you can actually deliver the product. The growth strategy trades operational security for market dominance. If your supply chain and cash cycle cannot handle the speed, that trade ends in sudden bankruptcy. The second option is stability. Think of this as dropping an anchor. It is a calculated refusal to accept new customers after a period of intense scaling. You redirect the capital and manpower that would normally go to sales and pour it into your backend. You install the new enterprise resource planning software or upgrade the machinery sensors on your factory floor. Because the production line is no longer strained by endless new orders, you can calibrate the equipment. Waste drops drastically, and the profit margin on every existing contract goes up. Looking back at our directional matrix, we see that stability has its own strict requirements. A valid stability strategy requires a hard deadline. You are pausing to execute a specific systems upgrade within a locked timeframe, say 6 or 9 months. If leadership announces a pause but implements no operational upgrades, that is not a strategy. That is executives getting comfortable and coasting on past momentum. Hold the pause too long and your product roadmap stalls. The organization stagnates, making you incredibly vulnerable to newer, leaner startups eager to take your place. Stability trades outward expansion for internal efficiency. It is a highly effective temporary reset mechanism to prepare the whole for the next sprint. The third path is retrenchment. This is the amputation. It is a severe, painful reduction of the company's size to ensure the core enterprise survives. You cannot execute this based on a gut feeling. Leadership must pull strict cost accounting data to locate exactly where the business is hemorrhaging money. Once the data isolates the failing divisions, the company initiates divestment. You cut off and sell the unprofitable units to the highest bidder. The sale generates an immediate influx of liquid cash. That cash is then used as a shield to protect and fund the primary, profitable divisions of the business. Sometimes a direct sale isn't possible. A struggling manufacturer might choose the captive route, volunteering to become a dedicated subcontractor or OEM for a much larger direct competitor. You surrender your brand autonomy entirely. In exchange, you secure guaranteed production orders and keep your workforce employed through a severe recession. Returning to the matrix, we can quantify the toll this path takes. Divestments and layoffs trigger a severe, immediate drop in employee morale. It requires executives to stand in front of their teams and publicly admit a major initiative failed. Retrenchment sacrifices executive legacy and pet projects for the raw, unglamorous survival of the company itself. Effective corporate strategy relies heavily on the discipline of deciding what you are not going to do. To strip personal bias out of the planning process, boards can use a diagnostic checklist to force an objective decision. This logic tree maps the sequence. The first gate asks, are you consistently bleeding cash? If the answer is yes, you stop looking at growth projections and immediately shift to retrenchment to stop the infection. If your cash is stable, the second gate asks, are your supply chain and back-end systems currently breaking under existing order volume? If yes, you halt new sales and shift into stability to fix the pipes. Only if your systems are stable do you reach the final gate. Is the overall market expanding, and is your debt-to-equity ratio healthy? If the math supports it, you are cleared for growth. Following this tree forces leadership to do their actual job. Often, that means presenting a mathematically sound strategy, like a hiring freeze, knowing it will be deeply unpopular in the room. Deliberately dropping an anchor in rough water requires discipline. The specific direction you choose matters infinitely more than the speed at which you travel. Trading the illusion of perpetual momentum for a grounded reality check is how you ensure your company survives to navigate the next cycle.